Welcome back. So, before we continue, a quick recap of where we were last time with respect to bond analysis. We defined a bond as a legally binding agreement between the borrower, who is the bond issuer, and a lender, who is the bond holder. This agreement specifies the principal amount of the loan, the size and timing of the cash flows that are to arise on account of interest and the repayment of principal. These cash flows, that is the interest payments, may be defined at a fixed rate or may be defined with reference to another variable like the LIBOR or MIBOR, so on, in which case the bond is called a floating rate bond. If the interest rate is fixed, then the bond is called a fixed rate bond. Some terminology: maturity, it is the point in time at which the bond matures for the repayment of principal, and the time remaining from today up to the maturity date of the bond is called its term to maturity. The face value is a very important concept. It is the notional value, it is the nominal value of the bond, it is the value of the bond with respect to which coupon payments are made. In other words, to arrive at the cash flow on account of the coupon payments, we multiply the coupon rate, which is given in terms of the percentages, with the face value. Similarly, the redemption value is also usually expressed in terms of the face value, either it may be at face value or it may be with reference to the face value at a premium or a discount. Coupon rate is the rate of interest, is the contracted rate of interest. Please note this very important difference. It is not the market rate of interest, it is the rate of interest which is given in the issue document, it is the contracted rate, and in the case of a fixed rate security, the coupon rate will remain fixed over the life of the bond. The frequency of coupon payments, well, that is also specified in the issue document, and that is singular to the instrument as the coupon rate itself. In fact, the coupon rate and the frequency of coupons need to be specified together to arrive at the cash flow pattern arising from the bond. Bonds may be selling at a particular point in time at a premium that is above face value, at a discount that is below face value, or they may be selling at par, that is at face value, depending on the relationship between the coupon rate and the then prevailing market rates of interest. Bonds may be redeemed at face value, which is usually the case, but not necessarily so. Bonds can be redeemed at a premium, bonds can also be redeemed at a discount. There are no legally binding restrictions, impediments on the redemption of the bond either below or above the face value. But it is important here to emphasize that whatever the case may be, whether the bonds are to be redeemed at a premium or a discount, the amount thereof needs to be specified, or the percentage thereof needs to be specified in the issue document. In other words, the redemption proceeds need to be unambiguously specified in the issue document. You cannot you cannot have a situation where the redemption value is fixed at a later date during the life of the bond. It has to be pre-specified in the contract of issue. Then we came to a very important concept, a very fundamental concept in finance, the concept of intrinsic value. I emphasize that the intrinsic value of a security is not only security specific, it is also investor specific, in the sense that the intrinsic value of an instrument is arrived at by an investor on the basis of a model chosen by him, selected by him, which he deems appropriate for the valuation of the security under analysis, under consideration, and on the basis of the inputs that go into the model as estimated or as selected by the analyst or the investor, as the case may be. So, the important thing is that this is not a market based model, it is not a market based value, it is a value which is computed by reference to a model which the investor deems to be appropriate, and the inputs to this model are also estimated by the investor. So, to that extent intrinsic value is singular to the investor and gives the worth of the security as perceived by the investor. Of course, then the investor can compare his perception of of the value of a security as encoded in its intrinsic value with the current market price and take investment decisions accordingly. So, that is now then we talked about how the market trades emanate. As I mentioned just now, we have a reference between or a comparison between the intrinsic value that the investor obtains and the current market price, and on that basis identification of mispriced securities takes place and investment decisions follow thereafter. So, the key takeaways, let me read this out. In financial analysis, intrinsic value is the calculation of an asset's worth based on a financial model with inputs that are worked out by the analyst or the investor. By comparing the intrinsic value with the current market price, mispriced securities that may constitute potential investment opportunities are identified. Now, then I talked about the intrinsic value as computed by the discounted cash flow model. As per the discounted cash flow model, the intrinsic value of a security is the present value of all future cash flows that may be attributed to that particular security discounted at a rate which is appropriate to the probability or the riskiness rather of realizability of the cash flows. So, on the basis of the assessment of the riskiness of the cash flows, you arrive at the intrinsic value of the securities by discounting those cash flows at the risk adjusted discount rate. The formula thereof is given right at the bottom of your slide in the right hand corner. Then I discussed in detail the rationale of the DCF model by constructing two arbitrage portfolios. Portfolio A comprising of two deposits for a 2-year for calculating the intrinsic value of a 2-year bond, two deposits, one with a maturity of 1 year and the second with a maturity of 2 years, and comparing it with a portfolio that involves a bond which has a lifespan of 2 years and which gives cash flow C1 and C2 at the end of year 1 and year 2 respectively. I will not go through it again, and you can always of course refer to the previous lecture in which this was discussed in a lot of detail. Then this was generalized to the entire life of an n period security or a security which generates cash flows over n periods, and the formula thereof is given right in the bottom line of your slide. Then I came back to one particular point, that was the reference to the use of suffixes to describe interest rates. Why I had used suffixes to describe interest rates is because of a phenomenon which prevails in the interest rate markets, which prevails in the financial markets, and which is termed as the term structure of interest rates. What that means is that there is a functional relationship between the interest rates and the maturity of the underlying deposits. In other words, if you make a deposit for 6 months, you will get a particular rate which may be different from a deposit that you make for 1 year or 3 years. In other words, the maturity of the deposit determines or has a relationship with the interest rates that you get on the deposits, and therefore, it is necessary to specify the interest rates that are relevant to a particular cash flow discounting, because the cash flows arise in different points in time, and therefore, need to be discounted at the deposit rates which are appropriate for that particular time interval at that particular time point at which the cash flow is taking place. So, let us recap the steps in the valuation of bonds. Number 1, estimate future cash flows. I emphasized here that in so far as the estimation of cash flows of a security of a bond is concerned, it is a relatively easy exercise, because all the information that is required is encoded in the issue document, and you do not have to look far to get, or you do not have to do much research or study or analysis to arrive at the cash flows that are relevant to a particular fixed income security. The cash flows are pretty much contractual and are contained in the issue document, the size of the cash flows as well as the timing of the cash flows. The real challenge in the valuation of bonds lies in the estimation of the risk adjusted discount rate, because this rate encapsulates the risk profile of the cash flows that are going to arise out of the contractual obligation arising from the issue of the bond. In other words, it is here that the possibility of default in the realizability of the cash flows needs to be considered, and an appropriate premium added to the risk free discount rate to arrive at the appropriate rate at which these cash flows need to be discounted to arrive at the intrinsic value. I also emphasized at this point that if we use, instead of the inputs determined or infused inputs as analyzed by the analyst, if we use the market interest rates for discounting the cash flows arising from the security, what we will get on the left hand side is the market price of the security. So, if you put in risk adjusted market rates, you get the market price, and if you put in the risk adjusted investor specific rates or investor chosen rates based on his risk return perception, what you get on the left hand side is the investor perceived value, or what is called the intrinsic value. Then I discussed the issue of semi-annual coupons. It is quite straightforward. You double the number of discounting periods, you half the interest rate, the contractual interest rate, the nominal interest rates, or the coupon rate as you may call it, and you discount it for double the number of periods, and you also half the discount rate, because that is the convention that prevails in the financial or bond markets. This is an illustration of how the semi-annual coupons need to be treated. As you can see here, we are having 2 coupons per year, 2 coupon payments per year, because semi-annual payments are made, and the discount rate is also halved, and the number of periods is doubled, because we have now to consider 6-month period as the unit of time. Then I took up this example. It is a straightforward example, so I will not repeat working on it. The solution is given on this slide. Now, again I reiterate what I mentioned just a few minutes back, that similar to intrinsic value, if you use the appropriate market rates, what we will arrive at the market price of the bond. However, at the macro level, at the level of observation, it is difficult to observe the interest rates which relate to different maturities in the market. It is more easy to observe the market prices of securities. So, this expression or this principle that I have just elucidated operates backwards. In other words, on the basis of the market price, which is a very easily and very precisely observable quantity, we work backwards and we arrive at the relevant interest rates for various periods of discounting. For example, by noting the price of the 6-month bond or a bond which has a remaining tenure of 6 months to maturity, by observing its price in the market as of today, we can get an estimate of the 6-month spot rate prevailing in the market or 6-month interest rate prevailing in the market. Similarly, by observing the current market price of a bond which has a maturity of 1 year remaining, we can arrive at the 1 year interest rate that is prevailing in the market. So, in practice the principle that is given on the slide operates in the reverse direction. We first take the price, we first obtain the price as the market input or as the quantity or the parameter determined by the market, and on that basis we work out the implied interest rates. So, let us recap one thing. In the case of fixed income bonds, the magnitude I have mentioned just this point a few minutes earlier. I reiterate this because this is important. In the case of fixed income bonds, the magnitude of the cash flows is fixed by the contract of issue. So, there is little chance of difference between the market estimate and the analyst estimate or the investor's estimate, because this is given in the contract of issue. So, whether you do the analysis, I do the analysis, X does the analysis or Y does the analysis, is pretty much going to use the information that is contained in the contract of issue. However, the entire gamut of mispricings or the perceived mispricings by an investor therefore vests in the assessment or the calculation of the discount rate, calculation of the risk adjusted discount rate. Now, again, because the risk free rate is pretty much a universally accepted number, therefore, this analysis boils down to, or this tenet boils down to the fact that it is the perception of risk, it is the assessment of risk and the embedment of that risk in the risk adjusted discount rate, that risk premium that we try to calculate to add on to the risk free rate for arriving at the risk adjusted discount rate, which is going to give rise to identification of mispricing of securities. In other words, if my perception of risk of a particular security, of a particular bond is different, or if I ascribe a different risk premium to the riskiness of the realizability of cash flows of a fixed income security compared to what the market does, compared to what the collective wisdom does, then obviously I will end up with a situation where I perceive the security as mispriced and I may take investment decisions accordingly. Value of a discount bond, this is quite straightforward. In the case of a discount bond, that is a bond that is issued at a discount and redeemed at par, for example, and with no intermediate cash flows. The value is because there is only one cash flow and that is the face value at the date of redemption of the bond, let us call it capital T. Therefore, the current market price is the discounted value of that final cash flow at the appropriate risk adjusted rate, which may be the market rate if we want to work out the market price, or conversely, if we know the market price, we can work out the market prevailing interest rate corresponding to the riskiness of the bond and the tenor of the bond. So, otherwise we can also fit in or plug in our estimate of the discount rate and arrive at the intrinsic value of the bond. Similarly, for a level coupon bond, what we have is this situation. Because what is a level coupon bond? A level coupon bond is a bond which has a fixed coupon rate over the life of the bond and then redemption usually at face value. In fact, most of our analysis that we are going to do so in this particular segment of the course would be on the basis of the assumption of a level coupon bond unless explicitly specified. So, in the absence of any specification, in the absence of any explicit information, we will assume that the analysis that we are doing is a level coupon bond, the coupon rate is fixed and the redemption is at face value, what we call a plain vanilla bond. It is also termed as a plain vanilla bond. So, in this case we have this formula, and because the interest rate or the coupon rate is fixed over the life of the bond, you can take it outside the summation. The coupon rate is small c, the cash flow is capital C. Capital C with the suffix t represents the cash flow at the point in time t, small t, which is arbitrary, which is the summation index, and because each is c over the life of the bond or each cash flow over the life of the bond is of a fixed rate, is at a fixed coupon rate, and which is small c. So, small c applied on the face value will give me the coupon payment in dollar terms, in money terms, in rupee terms, which is the cash flow at the coupon points, at the payment of coupon points in over the life of the bond. And then of course, you also have to account for the final payment, the repayment of principal, that is the face value of the bond, which is given by the second term. Now, we talk about spot rates. Very important concept, spot rates, which naturally leads us to the concept of yield to maturity. So, what are spot interest rates? Spot interest rates are the YTMs. What is YTM? YTM is the short form of abbreviation for yield to maturity. We shall be talking a lot about this in the context of this particular chapter of the course. We shall be coming back to it in a few slides. For the moment, let us continue with the definition. Spot interest rates are the YTMs on bonds that pay only one cash flow to the investor, which in fact which are called zero coupon bonds. So, we can say that spot interest rates are the YTMs on zero coupon bonds, bonds which do not have any coupon payments, which are either issued at discount and redeemed at face value, or issued at face value and redeemed at a premium. So, spot interest rates are usually calculated and quoted for 6 monthly intervals and then annualized by doubling the 6 month rate, as we saw in the example that we did a few minutes back. So, what is YTM? That is the most important concept that we have in the case of fixed income valuation, fixed income securities valuation. So, yield to maturity or YTM, I shall be using this abbreviation YTM, it saves a lot of time. YTM is the discount rate that equates the present value of future cash flows from the instrument to its current market price, including accrued interest. For the moment, let us keep the issue of accrued interest separate to keep the exposition tractable, to keep the exposition simple. We shall return back to it at a later point in this course, in this chapter in fact, in this segment of the course, but at a later point in time. So, let us assume that the bond is being valued at one of the coupon days just after one of the coupon payments has been made. So, what we are saying now is that the yield to maturity is that discount rate which equates the present value of all future cash flows attributable to that instrument to its current market price. So, P 0 is equal to summation of C t divided by 1 plus y to the power t summed over all values of t which are relevant to the tenure, which are relevant to the life of the bond. Clearly, in the case of a zero coupon bond or a pure discount bond, because there is only one cash flow and which is at maturity, we will have P 0 is equal to f divided by 1 plus y to the power capital T, where capital T is the maturity of the bond and y is the yield to maturity of the zero coupon bond or the discount bond. So, rationale of the definition. Now, the rationale of the definition clearly follows or easily follows from the definition of intrinsic value or definition of market price of the bond vis-a-vis the definition of yield to maturity. We just in the DCF model, we just discussed the issue of how the value of a discount bond would be calculated. It would be calculated by the upper equation that appears on your slide. F is the final value or the face value of the bond, assuming redemption at face value. S 0 t is the discount rate for a spot deposit of maturity capital T, which is the maturity of the bond, and we arrive at the current price if S 0 t is the current market interest rate. Of course, if S 0 t is the investor's estimate, you arrive at the intrinsic value on the left hand side. But let us assume this is the current market interest rate relating to a maturity of capital T years, then what we arrive on the left hand side is the current market price. And as far as the definition of YTM is concerned, well, YTM is what? YTM is that discount rate y at which the future cash flows, there is only one cash flow in this case, which is the maturity cash flow, which is the face value. So, we have f discounted to arrive at the current market price or equated to the current market price. So, this is from the second equation arises from the definition of YTM. The first equation arises from the definition of the DCF model. If you compare the two, what you immediately get is S 0 t is equal to y, and which is the definition that we propounded in the previous slide. Let me just read it once again. Spot interest rates are the YTMs on zero coupon bonds. So, that is precisely what we are getting here. The spot interest rate S 0 t is equal to the YTM of this zero coupon bond which we are considering in this slide. YTM of level coupon bonds, where the process is the definition is same, V 0 is equal to summation of C t divided by 1 plus S 0 t to the power t. Now, this is also equal, this is the definition of that arises from the DCF formula. The left hand side, this first part is is what arises from the DCF formula, and the second part, this part arises from the definition of YTM. So, if you equate the two, you can get some relationship between the interest rates, the spot interest rates and the YTM in the case of a level coupon bond. And let us now investigate the relationship between coupon rates and YTM. That is very interesting, and that can be done on the basis of the formula that we arrive right at the bottom of your slide. V 0 is equal to f plus f into C upon y minus 1 into 1 minus 1 upon 1 plus y to the power t. So, we look at this formula. This is the first formula is simply the reproduction of what I just read out from the previous slide. Now, a bit of rearrangement enables me to write this formula in the form that is given in the second formula, this equation. Let us call it equation 2. Let us call this equation 1. Okay. So, now if you look at equation 2 very carefully, you find that the second factor, that is this factor, if y is greater than 0 and t is greater than 0, which is normally the case, if y and t are both greater than 0, then what can we say about this factor, the second factor, the factor in the square brackets? What we find is that it will always be greater than 0, it has to be greater than 0. This factor which is within the square brackets, because the second term in this factor will be less than 1 obviously, if y and t are greater than 0. That means, the sign of the left hand side, the quantity on the left hand side, its sign will be determined by whether the first factor, that is c upon y minus 1 is positive or negative. If c upon y minus 1 is positive, the left hand side will be positive, and if c upon y minus 1 is negative, the left hand side will be negative. What does this mean? It means that if c is greater than y, that is the coupon rate is greater than the yield to maturity, the bond will trade at a premium, V 0 will be greater than f, and if c is less than y, then the bond will quote at a discount, V 0 will be less than f. And of course, if c is equal to y, then the right hand side becomes 0, and therefore, V 0 will be equal to f, or the bond will be quoting at par. So, this is a very important inference again, that depending on the relationship of the coupon rate and the YTM, we can arrive at whether the bond should technically quote at a premium, a par or discount. So, now we talk about returns, or the sources of return that are generated on a fixed income security. Well, first and most obvious is the coupon income, the income that arises out of contractual cash flows that are paid on account of interest when a person takes up a position, a long position in the bond, that is, he buys a bond, then he is entitled to coupon payments during the life of the bond as per the terms of the issue contract. Then if the coupon payments are reinvested by the investor. Suppose you receive a coupon payment at the end of you invest in a bond at t equal to 0, and then you receive a coupon payment at t equal to 6 months. You do not really need the money at that point in time, but obviously you would not like to keep that money, the coupon payment, that the credit in your account idle. You would either reinvest it in some other form, or reinvest it in the same instrument, or maybe leave it in your savings account, in which case you will get a savings rate of interest. Whatever the case may be, you would not like to keep not like to withdraw the cash and keep it in your drawer. That is not what a rational investor would do. A rational investor would either leave the money in his deposit account, in his saving deposit account, or he would invest the money somewhere else. So, the return that he would get by reinvesting the coupon payments is called the reinvestment income. The interest, in other words, we can say that this is the interest on interest component. You receive the interest, you reinvest the interest, and you receive interest on the reinvested interest. So, this is the second component of return that you get, and then there is the issue of capital gains. In the event that you are not likely, or you are not planning to hold the bond up to its date of maturity, you want to dispose of the bond at a slightly earlier date, then obviously you would have to sell it in the market to recover your price of the bond at the date on which you want to exit the investment. And in that case, of course, it is the market price which will be determining the, or will be a factor in determining the overall return that you are going to get. The market price would be maybe higher than or maybe lower than the carrying value of the bond at that point in time, and correspondingly you would get a capital gain or a capital loss. If you sell the bond at a price in the market higher than the price or the carrying value of the bond in your books, you will get a capital gain and vice versa. What is carrying value? It is defined in the slide. The carrying value is defined as the amortized value. I will come back to this again in a later slide and explain how this carrying value is calculated with an example, but for the moment let us stick to the definition. The carrying value is the amortized value on the date of sale calculated at the YTM at which the bond was purchased. In other words, it is the value, it is the amortized value which is in your books, provided that amortized value is calculated on the basis of the YTM at which you had purchased the bond. So, if your selling price is higher than the carrying value, you make a capital gain, and if your selling price is lower than the carrying value, you make a loss, capital gain or capital loss. So, there are three sources of income: the coupon income, the interest on interest or the interest on reinvested coupons, and then the capital gains. That is the difference between the selling price if you hold the maturity for a period if you hold the bond for a period less than its maturity, then the difference between the market price, the price at which you exit the investment, less the amortized value or the carrying value of the bond, that will constitute the capital gain or capital loss. That is another source of income from your investment. Now, we talk about the measures of yield. We have just talked about the sources of income on this security. We now talk about the measures of yield. First is the nominal yield, that is the coupon rate. So, nothing much to say about that. The current yield is defined as the ratio of the annual coupons, the total coupons that are paid during the year, and divided by the current market price of the bond. The yield to maturity, we shall talk about it again in a few minutes. Holding period yield, annualized holding period yield. Holding period yield I introduced in the concept of money market instruments in a previous lecture. We shall be talking more about this. Then we have annualized holding period yield, which is the same as the effective annual yield, EAY, and then we also have the yield to call, yield to put, if the bond has the properties of having a callability option or a putability option. We shall continue after the break. Thank you.